delta, gamma, theta, vega. If hearing those words makes your head spin, you're not alone. Most trading courses overcomplicate them. The truth is, you don't need a math theory to use them. You just need a professional to show you what actually matters. This video from our head of options trading will do exactly that. And it will fix the biggest mistake you can make, trading without understanding the Greeks. I'm Mike Bellafiore, and we're one of the top proprietary trading firms in the US with numerous 7 and even 8-figure a year traders. You've found the right place to learn.
Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And today we're going to be providing you with a super important lesson about options trading, a lesson that we think will crack the code for you and clear up a lot of the mysteries of options trading. And we're going to do that by explaining to you what is meant by the options Greeks. Now, let me be clear. You don't have to understand the Greeks to place an options trade. You could just go ahead and place the trade. I mean, most people would say, hey, I think the stock's going up, so I'll buy a call. Or, hey, I think the stock's about to crash. I think I'll buy a put. And my attitude used to be, what's so tough about this? You buy calls on stocks you're bullish on. You buy puts on stocks you're bearish on, and that's it, right? In fact, when I first started trading options, I thought the Greeks were just a bunch of random numbers that only hardcore math geeks cared about, and so I ignored them. But I quickly learned the hard way that if I didn't understand the Greeks, I wouldn't understand why my options trade was making money or losing money. I had experiences where, for example, I'd buy a call, the stock would go up, and I'd lose money on the call anyway. And I'd buy a put, and the stock would go down, and I'd lose money on the put anyway. And then at that point, I had to ask myself, what the hell is going on here? Is this some kind of a scam? Are option sellers just snake oil salesmen, and they're guaranteed to win every trade, and I'm guaranteed to lose every trade? And the truth is that if I had just understood the options Greeks, I would have not only understood why my call went down when the stock went up, and why my put went down when the stock went down, but I would have understood how to structure the trades so that if the stock goes up, my call position will make money. And if the stock goes down, my put position will make money. And the best part is that the Greeks are actually really simple to understand. And once you do, you'll realize how powerful they are, and you'll see that they will completely change the way you trade options. In fact, I've told my trading students many times that all I really think about all day when I'm trading options are the Greeks of my positions. That's my dashboard for profiting from options trading. And today's video is going to make that really clear for you so that you can get control of your options trading and begin to become consistently profitable. Now, in this video, I'm going to break down delta, gamma, theta, and vega, which are the 4 major Greeks. We're going to explain what each of these words means, how each of them actually works in real trades, and most importantly, how you can use them to make smarter trading decisions, protect yourself from risk, and give yourself an edge. By the end of this video, you'll see why traders call the Greeks the cheat code of options trading. So let's jump into the first Greek, which is known as delta. An options delta predicts, based on mathematical predictions that have been around for years, by the way, it predicts how much an options price will change based upon how the underlying stock that option's based on changes and moves by exactly 1 point. So for instance, if we go back to the market open on Monday, June 23rd of this year, you're going to notice that Meta stock opened up at 680.30. So let's take a look at an options chain for Meta that expires just about a year later on June 18th, 2026. And you'll see at the top of the options chain a number of different column headings representing the 4 major Greeks that we just discussed: delta, gamma, theta, and vega. And just so you understand, every single option has all of those 4 Greeks associated with it. Every option has its own delta, its own gamma, its own theta, and its own vega. And while they will change throughout the trade, up until the moment the option expires, each of those Greeks is going to exist for each option. And so for this purpose, we're going to zero in on the 60 delta call option, which as you can see is the 680 call, what we call the at the money call, because its strike price is located pretty much exactly where the stock is trading. And you'll notice that it has a delta of 61.48, actually, exactly, the closest option we could find to a 60 delta call. And so if that morning we went ahead and bought that call, the price is 109.77, as you can see. But remember, call options represent the right to buy 100 shares of a stock at a certain price. So you multiply that price by 100, arriving at a total cash outlay of $10,977 for buying that call. Now, here's where it gets interesting. Let's move to one day later at the open. So we're moving to June 24th of 2025, just a day later. And as you can see, Meta stock rallied since we bought the call the previous day, and it opened at 711.27, which is a rally of $30.90 from the previous opening price when we first put the trade on. And so if you focus on the price of the call that we bought, you'll see that the call's price is now 128.37. And so as we mentioned, Meta rallied 30.97 points from the previous open when we first bought the call. And so now let's think about the call that we bought. Meta stock went up 30.97. So how much did the call go up? Well, remember that we said that the call had a delta of 61.48. Well, what that delta means, and this is crucial now, is that for every dollar the stock went up, the options price would go up 61.48% of that. In other words, the option should go up about 61 cents for every dollar that the stock goes up. So let's do the math on that. As you can see, the options model that the delta comes from is predicting that the option would go up 61.48% of the stock's appreciation, or $19.04. And so when we add 19.04 to the option's original price of 109.77, we get 128.81, whereas the actual market price is 128.37. So the model was really, really close on that one. But remember, these models are not perfect. Plus, there are other Greeks that have an effect on the price as well, which we're going to be going over later. But just focusing on delta, the model did a pretty darn good job of predicting the price change in this case. And so again, while the models are not perfect, they're almost always going to be really close. So now you can see how an options delta works with an actual live example. But there's another very interesting thing about an options deltas, and that is that they are also a prediction of the likelihood of the option expiring in the money on the day it expires. And so let's look at an example of how options traders all over the world use an options delta to make money. You see, there's an option strategy known as the cash secured put. And the way it works is you actually sell a put option and collect premium for doing that. And then you hope the option expires worthless and you just get to keep, just to pocket the premium you got for selling that put option in the first place. So for example, let's head back to June 24th, 2024, when Meta was trading for 503.26. And so if we were bullish on Meta, but we wanted a little bit of room for error, why not sell an option that has only a 30% chance of expiring in the money when our goal is to have the put option expire worthless? And so a 30 delta option logically has a 70% chance of expiring worthless, because just think about it, that 475 price is more than 33 points below where Meta is trading, and we're bullish on the stock. And so if we sell that put at its price of 47.05, we're going to collect $4,705, yet we have a 70% chance of just keeping that cash and the put we sold expiring worthless. Incidentally, your broker is going to require you to have $47,000 in your account to make this particular trade that we're just using as an example. But you need to keep that in mind if you intend to trade cash secured puts, because you're going to have the funds to buy 100 shares of the stock if it closes below 470 on expiration day in this example. So keep that in mind if you're going to trade cash secured puts. And so if we move to June 20th, the day this trade expires, you could see that the stock closed at 682.35 on that day. And so with the put option now expired, then what does that mean for the result of our trade? Well, starting with that initial $4,705 of cash that we first collected, and realizing that that put expired over 200 points below where Meta closed that day, up at 682.35, that put expired with zero value. And that means that we just pocket that premium that we made initially. That becomes our profit on the trade. The trade's over, which makes sense, right? Because we already knew there was a 70% chance of that happening. And that's one of the main reasons we picked that 470 put in the first place. It only had a 30 delta. And so the two major ways that people use an options delta is to not only be able to predict the price change of an option based on how much the underlying stock is moving, but it can also be used as a way to create very high probability positive cash flow trades, just like we showed you with that example of the Meta cash secured put. Now, the next Greek we want to delve into is gamma. You see, while at any moment in time you can find on your broker platform an options delta, delta is not a constant. It changes as the stock price moves, and gamma measures that change. And so you can think of gamma as the gas pedal of an options delta. If an options gamma is high, then its delta will get higher quickly when the stock moves. Meaning that if, for instance, the call option has a high gamma, then not only will the option's value increase, but the delta of that option will increase by the amount of the gamma. Meaning that things can get pretty parabolic pretty quickly, and you can have explosive gains. And so the way gamma works, for example, the delta of a call option will increase by the amount of that option's gamma for every $1 increase in the stock's price. And the same is true for a put's gamma. The put options delta will increase by the amount of the option's gamma for every $1 decrease in the stock's price. And so, for example, if a call options delta is 40 and the gamma is 5, then if the stock rises $1, the options delta jumps from 0.40 to 0.45. And so what that means is that you can have some really explosive profits in trades if a stock moves a lot and the gamma is relatively high. And the closer and closer you get to expiration, the higher that gamma gets on all options. So let's take a look at an example. When Tesla opened up on April 25th of this year, its opening print was 262.03. So if we pulled up an options chain that morning, expiring 2 weeks later on May 9th, you would have found that 285 call, which has a strike price 23 points higher than where the stock's trading. And its delta was 28.52, and its gamma was exactly 1.0. And so what that's telling us is that for each dollar that Tesla rallies, the delta of that option is going to increase by 1. So we buy the call, which as you can see cost us $5.67. Tesla had a big rally that day and closed at 284.95, a monster 9.8% rally for the stock in one day. But what I want to focus you on is what happened to the delta of that option that day, because that's really interesting. You see, the delta, which started out at 28.52 at the beginning of the day, by the end of the day, the delta is now 58.35. That means at the beginning of the day, each dollar increase caused the option to rally about 28 cents. But by the end of the day, a 1-point move caused the option to rally by about 53 cents, almost double the change. In other words, the rate of change of the options prices dramatically increased as that stock rallied. Why did the delta end up at 53.11? How did it get so high when it started the day so much lower? And the answer is the call options gamma, the rate at which delta changes as the stock rallies. You see, we started out with a delta of 28.52, but the stock went up 22.92 points from where it was when we bought it. Well, with a gamma of exactly 1.00, that means the delta should be expected to go up 22.92 points. And so the predicted delta change would be 22.92, bringing it to 51.44, where the actual delta ended up being 53.11, very, very close to the predicted delta. And so this parabolic explosion in value takes place because as an out-of-the-money option with a reasonably high gamma gets closer and closer to the market price, which happened in this case where by the end of the day, the stock closed actually just under the call strike price. When that kind of thing happens, those call options prices with strike prices well above the stock price initially will parabolically increase because not only is it gaining value with every point increase in the stock, but the rate at which the increase happens is accelerating too, which is why some people call gamma the accelerator. It speeds up the options growth, giving rise to parabolic increases in value like happened in this example. And so if you think a stock is about to break out, buying a high gamma call option can lead to explosive returns, and the same is true for buying puts with a stock that you feel is about to break down. Either way, high gamma options can create explosive gains in the right situations. So let's move on to our next options Greek, and that is Theta, the Greek that options income traders refer to as their favorite Greek, and you'll see why that's true in a minute. Okay, so Theta measures how much an option loses its value just from the passage of time and nothing else. Just the passage of time. You see, every single day, every option bleeds value, even if the stock doesn't move. And that's because of Theta. Just think about it logically. Let's say you buy a call option at a strike price, say $10 above where stock is trading, and the option expires in a week. Well, if the stock basically doesn't move at all during the week and stays at its same price, what's going to happen? It's going to eventually turn worthless, right? What value is the right to buy a stock at $10 higher than the stock is trading in the open market? You'd never exercise that option. It would be incredibly stupid to do that. Instead, you'll just let it expire with no value, meaning that you've lost the entire original cost of the option and the trade goes to zero. Why did it drop from its original value to zero? Because of Theta, which is another word for the time decay that naturally occurs on every single option, because at the end of the day, that the option expires, an option is either in the money and has value, or it's out of the money and has no value. And because of that, as each option gets closer and closer to expiration, the uncertainty surrounding the final price of the stock is getting less and less. And therefore, the value of that option is getting clearer and clearer. And so Theta basically measures that. Theta basically predicts how much an option will lose value every day as it approaches expiration. Each day, the premium of an option is reduced by the amount of its theta, all other things being equal, meaning that if a stock didn't move and the implied volatility of its options didn't move at all in a day, then that option's premium would go down by the amount of its theta. So let's look at an example. On September 25th, Microsoft had closed at 510.15, and so if we went ahead and bought a call option 10 points higher to strike price of 520 and paid $8 for it, you'll notice in the theta column that the figure is minus 21 cents, which means that if nothing else changes, such as the stock's price or the volatility of the options derived from that stock, that the option should lose 21 cents in value each day, just because every day the chances of Microsoft reaching 10 points higher to 520 get smaller and smaller as each day goes by. And so an option to buy shares at that price loses value a little bit every day if you think about it logically. Okay, so moving forward to a week later, and we picked this example intentionally to give you as clean an example as possible, you can see that Microsoft closed at 510.15, almost exactly where it closed the week before when we started the trade. And we did this intentionally to try to clean it up so it'll be an apples for apples example. Now take a look at the price of that same 520 call option. It dropped to $6.50. How? Why would it be worth less when Microsoft is closing at essentially the same price as the day we entered the trade? And the answer is theta, the decay in the price of the option just due to time. Because with options, the less time a stock has to reach a certain strike price, for example, the lower the option's premium is going to be. It's just common sense. That option's running out of time to justify its value, and so its value is dropping. You see, theta calculations would have predicted that 7 days passing at 21 cents a day in this example would come to $1.47 of theta decay. So the final price that day would have been predicted to be $6.53 from the options pricing models. And in the final market price, it turned out to be $6.50. So again, really, really close to the predicted outcome because those calculations are based on common sense in the first place. And so this is the essence of how options income traders make their money. The core of their trades is to sell options and then profit from the time decay. In other words, the way to benefit from theta is to be short options, and you make money simply through the passage of time. That's why theta and the passage of time is an options income trader's best friend. The final of the big four Greeks we'll be covering in today's video is the Greek called Vega, a crucially important Greek that is often overlooked, but absolutely cannot be overlooked if you want to understand options trading. As we said, delta is about price movement, and gamma is the rate of change of delta, and theta has to do with the passage of time. But to fully understand options pricing, you need to add in one more element, and that is Vega, the way that options prices respond to the possibility of a big move taking place on a stock and the risk associated with that. If a huge move is about to take place on a stock and you're selling options, your risk has gone way up. For instance, if you're selling a call option with the strike price close to the market price that expires after a stock will be releasing its quarterly earnings report, then you're going to have to charge a lot more for that option than if it was just a regular expiration before which no big event was anticipated. Why? Well, earnings can cause huge rallies or huge sell-offs in stocks. Since you never know which way it's going to break, call and put sellers have to charge a lot more for options that are exposed to that earnings report, which of course are only options that expire after the earnings are released. Because if, for instance, you are a call seller and the stock has a huge rally off of earnings, if you're a call seller, you could be stuck selling your shares for way lower than they're worth after the earnings rally. So you better get paid for giving up the right to have that appreciation after earnings. And the fact that you are bumping up your prices to address the increased risk of, say, earnings, that phenomenon is called the implied volatility of an option, which is exactly what it sounds like. It's the amount of premium you're adding to the option as an option seller to cover an increased risk. Your price, in other words, is implying that something's up, like earnings. And so that's why your price is going to be higher than at other times. And so every option has what's called an implied volatility. And the Greek Vega specifically measures how much an option's price will change if there is a 1 point change in that option's implied volatility. And while Vega is a pretty nuanced subject, the basic dynamics of it are pretty easy to understand. For example, NVIDIA's earnings were on August 27th, this last quarter. And so any options expiring after that are going to be alive when earnings are released. And therefore, those options are going to be exposed to that volatility in pricing that always comes along with earnings. And so, for example, on August 15th, NVIDIA was trading at 180.45. So if we look a week out at the 185 call option expiring before earnings, and therefore not exposed to the volatility of earnings, with the strike price 4.45 points higher up at 185, we can see that the call option is priced at $1.43. And I'd like you to note that the implied volatility, the IV of that option is 31.30, and the Vega of that option is 8.65. You'll see why I'm pointing that out in a minute. Now, let's take a look at pretty much an apples for apples call option situation, except this time the option expires after earnings. Remember, earnings are on August 27th, and this day is August 22nd, which is before earnings, and the first options chain after earnings is the August 29th chain. And so at closing that day, NVIDIA was trading at 177.99. And so the call option, almost exactly 4.5 points higher up, is the 182.5 call option, again, expiring in a week. So pretty much very, very close to apples for apples. Everything's the same. The calls are about 4.5 points above the closing price, and the option in the previous trade and this trade are both expiring in 7 days. So you've got to be asking yourself, why the heck is the price $4.20 for this option when the previous call, same distance and time, and the price was only $1.43? And the answer is simple. Earnings is coming up. A huge move can happen off of earnings. The option sellers have to charge for that potential, as we explained before. So it costs nearly 3 times what the same apples for apples option cost last week, except for the earnings factor. And so how did the price get this big exactly? Well, take a look at the implied volatility of the option this time. It's 61.65, slightly more than 30 points above the IV from the previous week. And the Vega, the sensitivity to changes in implied volatility in this case, is about the same at 9.55. And so how did that price jump from $1.43 to $4.20? Well, let's see. The Vega is about 9.5 cents, as we just mentioned, and because of earnings, the implied volatility was almost double, 61.65. So that's a difference of 30.25 points of implied volatility from one week to the other. And so to figure out the huge price difference, we multiply that 9.55 cents times the difference in the implied volatility, and that results in $2.89 of increased price, which if you add it to the $1.43 price from the previous week, we end up with a predicted price of $4.32. But in fact, in the market, it was slightly less at $4.20, but still really close. And so that's the powerful effect that options Vega, its sensitivity to changes in implied volatility, has on its price, on any options price. In cases where the market really gets scared of a big move in either direction, you'll see implied volatility really spike, get very large on that option, affecting its price sometimes enormously, as it did in the case of NVIDIA, a very volatile stock that's been known to make massive moves off of earnings, as most traders know. And as you get more experienced, you'll notice this phenomenon actually happens with every stock. The options change for any stocks that are exposed to the earnings event. In other words, options change that expire after the earnings event will always have higher implied volatility than those that expire before the earnings event. As for the practical applications of Vega, it's a nuanced subject and one that beginners should be really careful with. But one very common approach is for traders to actually sell options that are super pumped up from an imminent large event. In other words, very high implied volatility coming up, and then buying them back, hopefully a lot cheaper when that event takes place. And now the uncertainty is gone. We know what happened. When that happens, the options usually return to a much more normal implied volatility level, and that in turn drops the prices of the options because of Vega, and therefore gives option sellers an opportunity for a great profit in what options traders refer to as the IV crush, the implied volatility price crush that happens after the fear of the big event has died down, after the event actually takes place. I'd suggest beginners not get involved in these kinds of trades, as they're a little dangerous, but potentially very lucrative at the same time as you gain experience. So as you now understand, options prices are impacted by all of the Greeks. And as you get better and better feel for how they impact your trades, you won't be guessing anymore. You'll be making informed decisions with risk and probability in your corner. So next time you pull up an options chain, don't skip over those numbers. The Greeks aren't random. They're the cheat code that separates gamblers from actual traders. If you want to be a professional options trader, you need to understand the Greeks. You'll eventually realize that they are the most important ingredient to your keeping a tight harness on your risk and maximizing your potential profits.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.